Hey, what's going on, guys? This is Terrence Ray, and I'm back at you with another stock market update. Right now, we're showing that we got the S&P 500 futures down about 0.5%. We got the Nasdaq futures down about 1%, a whole percent. The Dow futures are down 0.25%, and we got the Russell futures actually green on the day. The market has fought its way off of the lows. It opened up this morning early. It was down and it was down pretty big. And we could see a little bit, after lunch, we got about an hour to go before the closing bell. Looks like the market is pulling back a little bit. And so many of you may be, depending on your experience in trading or investing, you might be wondering, what direction the market is going, or if you're just looking at it. Like I generally just like look at the market for what it is, right? If it's going down, then obviously it's going down. But some people, look at longer time frames, and you may think that, hey, well, this is a bounce, and I'll try to pick it here. If it pops, I'll try to buy here, or I keep selling. But what do you do if you don't have a directional bias, or you just not good at picking direction, right? So maybe you're not a long-term investor, and maybe you're not good at picking direction at all. Maybe you don't, you're not into technical analysis or anything like that, right? So are there options for you? No pun intended. Yes, there is. There are things that you can do in the market to where you don't really care about the direction, right? We can take advantage of volatility. And so before we get into the trade, let's take a look at the VIX, which is measuring the volatility of the SPX, which is the S&P 500. So I'm gonna pull that up, and you can see the VIX we got a 20 VIX, which is pretty good. Like that's compared to where we've been. If you go back at the beginning of or middle of September, we already down about below 13. We got even, we got down to in the 12s. So now we got to fix back on the 23rd. They got all the way up to 23. So now currently we're at 20. So we can, just from looking at that, we can say that volatility has expanded, right? And so one of the things when you want to trade volatility, you want to sell options. That's one of the ways that either you can buy the VIX, do trades in the VIX, or and maybe another volatility product that's VIX related, the VIX futures or something like that. So you can buy the VIX. Well, you can only trade options, so you can buy options in the VIX, but you can't buy the stock. Now you can trade the VIX futures, which I do not advise, or you can come sell options, which is what I did. So let's go look at the SPY. Now, one of the reasons I use the SPY instead of the SPX, you can use the SPX. Just understand when you're using the SPX, it is a larger product. And so I do believe it's about 10 times the size of the SPY. So when you trade in the SPX, it's going to require more capital, and it can, if you're not used to trading something of that size, it can be. I've heard other traders call it the widowmaker. And so, I would stay in the SPY, depending on your account size. So right now I'm on the option table, and I went out. So when you want to with any option trade, basically any stock trade, but mainly options, you want liquidity. This is one of, if not the most liquid product in the market, in the stock market, as far as options is concerned. I know it's one of the top products, either the SPY, SPX, and then you got probably after that is the QQQ. Then maybe like Tesla, IWM, something like that, right? Tesla trades heavy in the options. So you can either come out to any of these expirations on the table because it's liquid. Generally, I would tell you to stay in the monthlies. For this particular trade, I've set up an Iron Condor. With an Iron Condor, and the way I do like to do mine, I like to go out around 55 days or longer. And I'll explain why. You can do them shorter term. You're going to be more the shorter the term or the expiration, you're going to be more subject to delta risk or the swings in the market. So when I go out 50 days, you're saying, hey man, you're going to hold this trade for 50 days? Not necessarily. I probably will be in it maybe 20 to 25, 30 max. And I come out 50 days. And so right away, I'm looking at the expected move. The expected move on the TastyTrade platform is $22.32. And it's going to is represented by this ruler in the middle of the option chain. So I generally, when selling options, especially Iron Condors, I want to be outside of this ruler. I want to be outside of what's expected. And so you can see as this trade is set up now, is I sold the 17 delta on the call side, bought the 11 delta, right? So that's a $5 wide call spread right here. And then you come on the put side and then you do a put spread, sell the 15 delta right here at 383, and then buy the 13 delta at 378. So that's $5 wide. And what that sets up, if I was to put that now, I've already put this trade on so you can see it, but I'm going to click on it again real time just so you guys can see what it will look like. And what you see is if I was to do this trade right now, it would give me 131 in credit. Whereas when I did it earlier, it was like 136. So that means that I need price for the next 50 days to stay in between these two short strikes. Now, if I did not buy the wing, that would make it a strangle. And as it is constructed right now, I have a 64% probability of profit, and I have a 82% chance of keeping 50% of this, which would be roughly what, 65, 66, $67. So when you set up these type of trades, which are generally delta neutral, as it is constructed right now, it's actually -2 deltas. So it's slightly bearish. And what this is I just need the market. Now, let's go and look at the analysis tab, and then we can look at the trade on the curve. So all I did was I left the table, clicked analysis, and then click curve. And now we can see what it looks like here. So you can see I need the market to stay in between here. And over time, options will lose their value, or they should. We could always, get a real big sell off, and then volatility could increase, right? And that would go against me. So basically, I'm shorting volatility. I want vol to come in or to contract. So I don't really care too much about. I'm not bullish. I'm not bearish. I just need the market. It can bounce back in between here. It can even go out of here. Let's say we get a big sell off. They come down here within a week and then pull back in a week. I'm still good. And so I just need the market to stay within here. And then I need time to continue and vol to contract. And so this is a trade that you can do where you don't really care about direction. You don't care whether it goes up or down. And this is one of the things that you can do with options, and where Basically, direction doesn't matter. You don't really care about any of this, to be honest with you. I could blank this screen and none of this would matter. Only thing that matters is I know that volatility has expanded by the VIX, as we went and looked at the VIX. So if I go look at the VIX, look at the VIX. The VIX is up, evidenced by just looking at the chart, looking at the screen. We can see it from here to here. It's up. So what I'm banking on is that at some point in the next month or so, we'll get a little bit of a drift and it come back down into here. Time go by, and I'll make money that way. So I'm selling options instead of buying them. I don't really care about direction. So hey guys, if you got anything out of this video, let me know what you think. Let me know if it's something that you didn't understand. I can walk through it again, go over some more premium selling plays. Hit the like button, hit the subscribe button, and let me know what you think. Peace.